This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and information necessary to help you make sound business decisions. Thank you to the U.S. Small Business Administration for co-sponsoring our program and to our host organization, the University of Kentucky. Contact us at 502-625-0123 to get started.
Welcome, everybody, to Toolkit Tuesday. I'm Dave Etkin. I'm the Center Director here in Louisville, Kentucky. We are one of 17 centers across the Commonwealth of Kentucky. And as we kind of look forward to growing our businesses, and that type of growth takes some financing. And one of the best ways to finance your business is through SBA financing. I have as my special guest today, Perry Dunn, who is one of the best SBA lenders. He is with Huntington Bank. He is a SBA specialist there. I always tell people that Perry is the most tenacious banker in town. He, if the deal can get done, he will not stop until it is done. And he is the guy that can really kind of shepherd some really tough projects through to fruition. So we've worked together many years and had a lot of success with clients getting things done. And so I'm happy to have you here and share everything that you know about SBA financing, because there's a lot of folks out there that need that. And if you give me a second here, I'm going to bring up your slides and we'll get started right now. So Perry, take it away.
Take it away. All right, David, thank you for the very kind words. And yes, I agree. We have had a long, fruitful relationship as far as your all's office and what you all do. I can't extol the virtues of the SBDC enough. And it's great to be able to share in a partnership with you all and to be able to help people obtain financing and resources in order to start sometimes their life dreams to own and operate a business. So as David said, I'm with Huntington Bank. I'm an SBA lending officer. All I do is SBA all day, every day. It's the area that I specialize in. So I just want to kind of share some facts and figures about the SBA, how I can help you with your business and with your goals. And so if you'll just go to the next slide, Dave, we'll go from there. All right. I'll try not to read from this. I'll just kind of let you all read, and then I'll kind of go from there. But what is the SBA 7A? The 7A is actually a guarantee program administered by the U.S. government. It's called the Small Business Administration. I would say a lot of people are probably a whole lot more familiar with SBA today than they were pre-COVID because of the PPP loans, and we're not going to get into that, but it has certainly brought SBA to the forefront. So what the SBA is designed to do, it's designed to provide the collateral for any transaction that you may engage in if you have insufficient collateral to obtain traditional bank financing. So in a nutshell, the way it works is you start your business, and more often than not, we see people acquire businesses or we see them start their businesses. And there's a lot of misinformation as far as the SBA is concerned and collateral. The SBA is designed to fulfill that collateral component. You do not have to have additional collateral in order to obtain an SBA loan. So what the government does, they guarantee the loan 75 cents on the dollar. So hypothetically, on a $100,000 loan, let's say that you were purchasing a restaurant and all it was leasehold and FF&E, which really has no value to the traditional banker. So what the SBA does is they guarantee the debt. And so we get 75 cents on the dollar in the event of default. So what that does is provide that component. So if you'll look at number one, it's talking about different types of loans. So right now, up until September 30th, the SBA guarantee is actually 90%. That's as a result of the most recent CARES Act. But for loans under $350,000, the guarantee portion is 50%. So what does the SBA do for you? What it does is allow for extended loan terms and amortization, which will hopefully improve cash flow. In traditional lending sources, if you were to borrow money, and what we're going to do is call it permanent working capital. Permanent working capital would simply be any funds that were used for a purpose that did not have tangible collateral behind it. Most often in the conventional world, banks will only offer an amortization anywhere from 3 to 5 years, and maybe in some instances 7 years. But with the SBA, they allow for an amortization of up to 10 years. So Huntington Bank, we always go the maximum amortization of 10. And what that does is allow for a smaller monthly payment, which ideally improves cash flow. Additionally, the SBA allows for reduced down payments. I know a lot of people go out and do their own research and they look at the SBA and they read up on it. And the SBA can lend up to 90%. But just to kind of pull back the curtain a little bit, as far as banks, not just us, but most banks out there, although the SBA does allow for 90% loans, more often than not, banks are going to require additional capital in just to reduce the leverage. Typically, we like to see 20% down. And in some instances, we like to see as much as 30% down. It really just kind of depends upon the project that you're into. If you're looking at franchise space, then typically we're looking at anywhere from 15 to 20. And if you're in non-franchise, which means it's an independent concept, your own special idea, then typically we like to see 25 to 30% down. And again, that's just to make sure that you have adequate cash and you're under leverage, which is a smaller payment and better cash flow. So what it's designed to do is cover collateral shortfalls. That's the only thing it does. The SBA does not improve your cash flow. It doesn't improve economic conditions. It doesn't improve character. All it does is make up for the collateral shortfalls. Often SBA is available when extensions of credit are not available somewhere else. So hypothetically, you may go to your community bank or you may go to a national lender and want to borrow money, and they simply decline it based upon insufficient collateral. So that's where the SBA comes in, and they provide that collateral and allow us to get from point A to point B. And one of the best parts about SBA loans, there are no covenants or any type of financial monitoring, just financial reporting, which means you just have to provide annual tax returns to the bank for us to assess the overall credit quality on an ongoing basis. Next slide, please. As far as Huntington Bank, we are the #1 lender. This is in our footprint, our market area. Our market area consists primarily of the Midwest. We are Wisconsin, Michigan, Indiana, Ohio, Pennsylvania, West Virginia, Kentucky, Nashville proper, and Naples, Florida. We have added a couple markets since the slide was put together. We actually go out into California now, but we're the #1 lender in the nation as well, and not only in our footprint as far as number of units. So what that means is we make more SBA loans each and every year than any other lender in the United States. Now, I will say there is a competitor. They lead the SBA as far as volume is concerned. That means that they do more dollar amount, but what we do, our average size loan is about $350,000. I think their average size loan is $1.5 million. So we don't feel like they're really reaching down to the people that need financing the most. So what we do, we use the SBA financing to get capital to your business that don't fit most banks' credit profiles. If you're working with Dave and his group, they know where to look and what to do. A lot of times you may have already gone to your traditional lender and they decline the deal. For me, that's not a problem. A lot of times we've had individuals that have been declined 2 and 3 times by other banks, and they come to us, and as long as the project fits, we're able to get from point A to point B. So what we're always doing is trying to find a way to help business owners with their financing needs, because that's the business we're in. We're in the business of lending money, so we look for ways to get money out the door. Next slide, please. These are just some of our Huntington footprint numbers. Kind of shows you where we are relative to our competition. These are a bit dated. I think these are from 2020, maybe second quarter, but everything since then has remained largely the same. Next page. The SBA programs that we're looking at, we have what's called the Express under $350,000. That is, again, for that has a 50% guarantee. And then we have the 7A program, which is used for startups, business acquisitions, goodwill, debt refinance, commercial real estate, and equipment. So as we've already covered, the SBA is a government guaranteed loan program. So what we're doing is we're just providing the collateral, or they are providing the collateral. And again, it goes to the guarantees. The 504 program is used for real estate or large equipment purchases. We don't often see a lot of 504s, to be candid. More often today, we see people leasing space than owning space. But if you wanted to own your real estate and you just wanted to finance the real estate portion without any other costs involved, then we can certainly explore what's called an SBA 504. That is a 90% loan. What happens is the banks provide 50% of the project. The CDC, Community Development Corporation, and SBA provides 40%, and then your injection is 10%. So typically it is a fully secured loan at a 90% LTV. And on that one, we can go up to a 25-year amortization. Next page, please. Commercial real estate. The only real estate that is eligible for SBA financing is what is considered owner occupied. So that means that your business must occupy 51% of the total square footage of the project, less common area. So if you had a building that was 10,000 square feet, then you would have to occupy 5,100 square feet with your business operations. Now, that being said, many storage units and hotel motel are considered owner occupied real estate. You just have to be involved in the day-to-day business operations, but those do qualify for SBA financing. However, if you own rental properties, either 1 to 4 or commercial space, and it's purely for rent, it's speculative rent, then it is not eligible for SBA financing. One thing that we're able to do with the 7A when you own commercial real estate, we can do a blended amortization. So hypothetically, let's say that you're purchasing a business or starting a business and you own the real estate, and the real estate is worth, I'm just going to use small, simple numbers, $100,000. We can go out to 25 years on that, but let's say you need additional $100,000 for FF&E, permanent working capital, things of that nature of $100,000. That is limited to 10 years as far as the maximum amortization. So what we do, we combine 25 and 10, which equals 35 divided by 2, which gives us 17 and a half rounded to 18 years. So anytime we have real estate involved in the transaction, we're able to do what's called a blend and amortize a little longer. But please let me stress, we do not need real estate for an SBA loan. That is one huge misconception in the market, because a lot of times people go to community banks and the community bank says, hey, we need additional collateral. Quite frankly, that is absolutely not true. So we do not require additional real estate. Even if the loan amount is above $350,000, we're not going to require additional real estate. Equipment, typically equipment we're amortized by the useful life. Typically that's 10 years. Again, the SBA requires 10% down, but we're still going to require additional funds. Even though it says often no money down, things have changed a little bit in the past. So we are going to need that minimum 10% down payment and possibly more sometimes. Next page, please. Business acquisition. Business acquisitions constitute a very large part of the SBA business. So if you're looking to purchase someone's existing business, typical term and amortization is that for 10 years. Again, 10 or 20% down payment. That down payment can come in a couple different forms. A minimum of 5% has to come from the borrower, and the seller can actually carry the difference in a second note held by them as part of the equity. So an example of a goodwill purchase, hypothetically, if you were buying a company that makes $50,000 a year in net income, not gross, but bottom line income, plus depreciation and amortization. Right now, what we're looking at is about a multiple of 4 on those types of transactions. So that means the goodwill value of that $50,000 would actually be $200,000. So what we're actually doing is financing the cash flow stream. And as it notes there, we can go out to 10 years. Again, CRE, we can have a blended term amortization if it is inquired with the purchase. More often than not, we typically do not see real estate included in the business acquisition. So goodwill, again, goodwill is the tangible, the cash flow stream. So what we're looking for first and foremost on every transaction is cash flow. If it is an existing business, then we are going to rely upon the cash flow of the business as it stands today. So if you're buying it, we're going to look at the historical numbers. We're actually required to look at the historicals to calculate cash flow. However, if you are starting your own business, and you've gone to Dave and his group and they're helping you with your business plan, then what they're going to do, they're going to help you put together projections. We can use projections for cash flow on startup businesses. That's what we rely upon. Again, seller notes are welcome and subordinate to the bank. I'm not going to get too deep in the weeds on full standby on seller notes. That can be a rabbit hole. So I'd be more than happy to answer any specific questions related to a specific project when it comes to seller notes. Again, 5% injection from the borrower is required for the SBA. The exception to that rule is if you have a current business and you're expanding and buying a similar business with the same ownership percentage, then 0% is required down. So if you have a catering company and you purchase a competitor that's also a catering company, we can use the equity that you already have in your existing business, so you're not required to come up with any additional collateral. Next slide, please. Guidelines for eligible ownership transfers: 100% of the ownership must transfer. So you can't transfer anything less than full ownership of the company. So if somebody wants to stay in the deal, let's say that you've got somebody that only wants to transfer 50% and maintain 50% of the business, that would not be eligible. They must have a transfer of 100%. Additionally, the seller must exit the firm after 12 months. So a lot of times what we see is, in order to transition the business from the previous owner to the new owner, they may stay on in some capacity for up to 12 months to assist in transitioning the business from one owner to the next. Again, I'm not going to get too deep in the weeds here. This is on purchase agreements. There are very strict limits on that. I think probably more often than not, when you're dealing with Dave and his group, from what I've seen, you're probably looking at starting your own business as opposed to acquiring a business. So I'm not going to get too far into that, but if you have any questions, again, I'm certainly available to answer those on a case-by-case basis. Partner buyouts, they are well suited to the program. So hypothetically, if you've got a 60% owner, a 40% owner, the 60% owner wants to sell, the 40% owner can purchase that 60% interest, and they're not required to put in any down payment, because what we would do would look at their current existing ownership as equity in the transaction. Every deal that we do, which is an acquisition, we're going to get a business valuation. And again, coming back to the 4 multiple, in our experience right now, everything that we see in our business valuations is coming in at a 4 multiple of EBITDA. Again, EBITDA being earnings before interest, taxes, depreciation, and amortization. So we're going to take net income, add back depreciation and amortization. We can add back, in some instances, expenses that would not transfer with the business. So hypothetically, let's say if you had a business owner that leased a car, and that car lease was $2,000 a month, and then they were going to keep the car after the business transferred, then we can add that back in for cash flow purposes, because that liability is not going to transfer with the business. Next slide, please. Combining seller financing with SBA lending. Again, coming back to what I mentioned earlier, the seller can carry a note on the business to provide additional equity into it. So the goal of that is, if the seller is providing additional financing, typically we're going to place some type of standstill on them, meaning that the seller cannot receive payment on those notes. It depends upon whether it's part of the equity component, which is up to the 10%, or if we're just looking for additional cash into the business or less leverage. So typically what we would see, let's say you put 10% into the business and then the seller carried 10%. That 10% that they carry would be on standby for up to a period of 24 months. And then after 24 months with acceptable financial performance, we would allow you to begin making payments on that debt to the seller. So what that does is buy you 2 years of better cash flow, because you're not required to make payments to the seller on that 10% debt. So that's typically the goal when we have seller financing involved, is to create as little leverage for the new owner as possible, at least in the short term, so they can get their feet under them, become familiar with day-to-day operations and maintain the cash flow stream that they purchased. Next slide, please. Typical terms and loan types, again, debt consolidation to refinance. Let's say that you've got an existing company and you've encountered some hard times, or let's say that you've gone to other lenders and were able to obtain financing from them, but at reduced amortizations. And if the economic winds shift and you're having a bit of a cash flow problem because of the debt you have, then what we are able to do is called a balance sheet reset. So you can push that button one time, which means that we can take all the debt that you have on your balance sheet. We can combine that into one simple loan and we can amortize it up to 10 years. And so ideally what that's going to do is stretch out the payments, give you a smaller payment, and allow your cash flow to improve by the result of the lower down payment. Again, coming back to down payment amounts, 10% and 20% for cash flow. We can do refinance of equipment and real estate that have a blended term. Refinancing SBA loan with an SBA loan is possible. However, it is getting more difficult as time goes on. So if you've gone to the SBDC to try and get some help with your existing operations, come up with some projections. If you do have an existing SBA and we were looking to refinance that, the SBA on very, very rare occasions will allow that to happen. We would have to get a letter from your existing bank, and then we would have to be able to demonstrate the advantage for the client as to why this debt refinance was good. Anytime that we do that type of transaction, we must actually send it to the SBA for approval. So let me make a point of clarification here. Huntington Bank, we are what is known as a preferred lender in the SBA. So that means that the deals that we do not have to send to the SBA for their approval. We have done so many SBA loans. If we stamp it SBA, then the SBA automatically provides the guarantee on the debt. So anytime that we have to send in a refinance, we have to send it what's called GP. We have to send it to them for their approval. The big reason for this is because there is a guarantee fee on every SBA loan that you do. The guarantee fee is 2.5% of the guaranteed portion of the loan. And typically what we're going to do, or not typically, but always, we're going to add your closing cost into the loan. There is no mechanism to allow for a waiver of an SBA loan fee. So the reason the SBA is so reticent to approve those types of transactions is because you've already paid that SBA fee one time when you got the original loan. And then if you refinance, then you have to pay that SBA fee again. So that's really the basis behind them not particularly being favorable of refinance of SBA debt. Next page, please. Here's some of our typical terms and loan types. SBA is very well suited for leasehold improvements and expansion. So leasehold simply means that you do not own the real estate that you're going to occupy. So if you want to go into a space and you want to fit that space up, it's going to be money out of your pocket. However, the improvements that you make to the property are actually owned by the landlord and not you. So anytime you make improvements on leasehold space, it holds no collateral value to the bank because all those improvements are retained by the borrower. I'm sorry, by the by the landlord. Leasehold improvements can be very expensive. You know, it can cost anywhere from $150 to $200 a square foot to fit up space. So we see a lot of that in the restaurant space. You know, some of the deals that we've done in the last little bit, which had leasehold numbers. I don't know if any of you all have been to PG&J's Dog Bar, but they started out with the SBDC, and then we wound up financing that project for them. That's lease space. So all the costs that they had to use to fit that up to make it a workable business, we're able to finance that for them in the form of the SBA guarantee. Startups, it comes down to, is it a franchise or is it not? So if you're looking to purchase a franchise, that is a lower risk profile for the bank because what you're doing is relying upon the expertise of the franchisor when things get difficult. In order for us to finance a franchise, the franchise must be on the franchise directory per the SBA to be eligible. If they're not currently on the SBA franchise, it's a fairly simple process to get them in the registry. But we have to make sure that they're part of the SBA registry in order to allow for that to happen. The immediate must-haves that we have on startups, obviously we need a PFS, personal financial statement. We also need a breakdown of project sources and uses. Dave and his group were fantastic about that. I love the worksheet that they prepare because it really outlines these areas very well for me. And then what we're going to be looking for is we're going to look for a management resume. So we want to know what is your personal background that allows you to be successful in this space. So if you're looking to open a restaurant, then we're going to want to see some restaurant experience. We want to see that you've been in the business and you have something that's going to allow you to be successful in that field. Next page, please. Yes, Huntington National Bank will lend to startups. Startups are the absolute highest risk profile there is. There are very few lenders that will lend in the startup space. So any business that is less than 2 years old is considered startup. Ideally, we like to see some outside income when we have a startup. That way you're not entirely reliant upon the success of the business to manage and pay for your personal debt. So hypothetically, if you're going to go out and start a business and you have a spouse that is going to have salary and wage income, that's what we're going to like to see, because then we know the spouse's salary and wage is going to pay your personal bills, that we don't have to take a distribution from the business. For startups, we have to have the business plan with 3 years projections. We're going to have what's called the house and the spouse conversation. So anytime that we have a loan that is over $350,000, the SBA automatically requires us to take what's called an abundance of caution mortgage on that real estate if there is equity exceeding 25%. So if you have a home that is worth $100,000 and you only owe $50,000 for it on it at the time, then the SBA is going to require that you pledge a mortgage on that property. And additionally, going back to the spouse, if we need their income to be able to support cash flow, then what they would have to do is sign on the loan as well. So we call it the house and spouse conversation. Anytime that you're looking at borrowing money, we encourage you to have these conversations with your spouse so they understand exactly what they're getting into. You may sit there and scratch your head and wonder how a spouse could start a business and not have any conversation with their significant other. I will give you a personal experience. I had a business acquisition last year, and we had to have the house on the loan, but we did not have to have the spouse sign. So we had to have a mortgage pledged on the home because Kentucky is a dour interest rate. That means that the spouse automatically has to sign the mortgage. We're at closing, and I asked him, I said, "Where's your wife?" Because she has to sign a mortgage. He said, "Well, she's not here. She doesn't know that we're pledging the house." So he had to call her up, have her come to the closing, and have her sign the mortgage. And she had no idea what was going on. All she said was, "You're putting a mortgage on the house?" And he said, "Yes." And she signed and turned around and walked out. So I had the feeling that it was probably not a very pleasant conversation at the end of the evening. That's a conversation that you want to have with your spouse on the front end. What we're looking for on startups is strong equity injection, sometimes up to 30% for a high-risk industry. High-risk industry, going to go back to the restaurant, typically 20% required, and sometimes as little as 10%, but that is less frequent than what we had seen prior to COVID. You do have to have good personal credit. So you have to have a credit score above 640 to qualify for an SBA loan. Next page, please. Well, leave it there, David. I want to go back to one thing because I know this question comes up quite a bit. Bankruptcy. A lot of banks, they like to take the easy way out and say that if you've taken bankruptcy, you are not eligible for SBA financing. That is not true. Prior bankruptcies do not exclude you from SBA financing. The only requirement is that the SBA is going to say that the bankruptcy must be fully discharged. Typically, we're looking at 7 years from the date of bankruptcy. And additionally, any credit that you have obtained after the bankruptcy must be paid as agreed. So if you took bankruptcy for medical bills, and that was 8 years ago, and you've obtained credit since, and you paid everything as agreed, then there should not be any issues with that bankruptcy. However, if you've taken bankruptcy, obtained new credit, and have had difficulty making the payments and have past dues, then that's going to be an issue. So SBA Leads, we're going to go back to bars, rest. I'm sorry?
I'm sorry, Perry, it's Janet. So on the previous slide, someone has asked if you would repeat the portion about the mortgage.
The mortgage, okay. So if the loan amount is over $350,000, the SBA is required, or the SBA requires us, it's called any and all available collateral. And this is an SBA guideline, so it's not subject to bank interpretation. But if you own a piece of real estate and on your personal financial statement, it indicates that you have equity greater than 25%, then the SBA is going to take what's called an AOC mortgage, which means abundance of caution. What that means to you is we're not going to do an appraisal. We're not going to do anything of that nature. The only thing they're going to do is take a mortgage on the property to secure the position of the SBA above 350. Now, what that means to you is this, and where it does have an impact. What this means is at a future point in time, that if you want to go get a home equity line of credit, then chances are you would be unable to obtain that because the SBA would have their mortgage. The bank that's doing the home equity would probably ask the SBA to subordinate their position, and the SBA will not do so. Now, this does not preclude you from selling your house. So hypothetically, let's say that some point in time you decide you want to downsize, then what you can do, you can sell your home and the SBA will release its collateral position to allow the transfer of that asset. But what they would do, when you purchase your new home, they would come back and take a mortgage on that. I hope that answers the question.
Thank you, Perry.
You're welcome. All right, so back to leads, high risk industries, 20% down, outside income, the high risk bars, restaurants, and gas stations. Manufacturing, good candidates, they typically have some type of collateral, but not necessarily needed. Turnaround, how early is too early? It's never too early. Acquisitions, historical cash flow, we're going to look at the business and we're going to make sure that the business is trending in the right direction. And when I talk about trending, we want to see that the top line revenue is moving from left to right in an upward position, meaning that sales are increasing over time. And ideally, bottom line profits would also be increasing over time as well. So if you've got a business that in 2018 did $1 million in gross sales and $100,000 net income, and in 2019 sales had dropped from 100 to 990 net, and then in 2020, excluding COVID, if sales had dropped from 800 to 700 and net income went down to 70,000, then we've got a negative trend. So that means the business is trending downward to the right. Those types of transactions are very difficult because we know the business is in a decline. We would try to figure out why it's declining, but typically we want to see businesses that are flat, which means same year-over-year sales, or trending up a little bit or a lot, ideally. Again, combination buyer-seller participation is a common structure. We've discussed that. We want to know that you've got access to capital needs. It's important structure. So what we're going to do ideally is offer you a revolving line of credit in order to assist with post-acquisition liquidity. And we typically require any and all available collateral when shortfalls exist. I do see the question pop up about COVID in 2020. And this comes up a lot. All right. As far as from underwriting, we understand that 2020 is an aberration. Okay. So believe it or not, that goes in two different directions. What we've seen is some businesses suffered very greatly as a result of COVID. specifically restaurant businesses and hotel motel for obvious reasons. But the converse that we have also seen is some industries actually did very, very, very well from COVID. COVID was a boon to their sales. For example, anything that involved being outdoors in 2020. So if you owned an ATV dealership selling side-by-sides and ATVs, chances are 2020 was a record year for you. So what we're doing is we're trying to look at 2020 and look at it in the context of what it was. So if 2020 was an outstanding year for the business as a result of COVID, with prior years being weak, then chances are we're going to throw out 2020 because it's not indicative of the sales prior to COVID. Conversely, if sales have fallen significantly in 2020, which is what we expect, then what we like to see in 2021 is sales levels rebounding to 2019 numbers. Kind of the number that we put out there. Once the business has rebounded to 75% of pre-COVID sales, so if they were doing $10,000 a month gross prior to COVID, then we would want to see them doing $7,500 a month gross post-COVID in order to make a good decision on that. So that's kind of what our expectation is as far as COVID is concerned and how we analyze the cash flow on those businesses. Storybook lending, numbers tell the story. So we want to know what events have transpired and why you're profitable. For example, I had a meeting today with a catering company. They had very, very outstanding numbers. And when I was looking at the cash flow statement, or not the cash flow statements, but the profit and loss statements, the first thing that jumped out to me is that his cost of goods sold was 20%. The normal in the restaurant industry is about 35%. So my first question to him is, why are your cost of goods sold numbers so low relative to the industry? That's the story I wanted to hear. Basically, what he told me was that they manufactured their own sausages, and so they were able to get product at the wholesale level, and then they were able to convert it to a retail product, so that kept their cost of goods sold low. So we're going to call that storybook lending. The numbers tell the story, and we want to know the events behind the numbers. Next page, please. Business acquisitions. We've seen a lot of those recently. In 2021, I've done 5 business acquisitions. I don't know, 0 to 10% is not correct. We're looking at 10 to 15% now. We want to see key employees in the transition. Again, if you've got a key employee that is buying the business, that is very helpful because we know that they already understand the business. So typically we like to see someone that's already involved as far as the acquisition, real estate, owner of business for 2 years. Expansion, we allowed a franchisor to grow in additional locations. We see that a lot. I do a lot of McAllister's Delis. The franchise reps, when they're selling the space, typically they like to sell 1, 2, and 3 at a time. So we allow for that type of expansion. Debt consolidation, we did refinance a company that had 30 operating leases. We were able to spread the payments out over 10 years, saving them $20,000 a month. Obviously, that helped their cash flow tremendously. And we were able to refinance 9 debt payments and the 1 loan amortized over 25 years, improved cash flow by $18,000. Now, obviously, that had real estate involved if we were going to go out over 25 years. Startups, we've done New Craft Brewery, Tool Rental Company, and PG&J's Dog Bar. Huntington Bank did that, and that came from David and his group. I think that's a great success story. I don't know if any of you all have been there yet, but they're doing extremely well, and that's kind of a little bit outside the box. But what you see is, what we're going to call a dog bar. There is a lot of industry in the pet. A lot of interest in the pet industry right now. So we're seeing a lot more of that. Next page. Oh, Tara Murphy. I'm sorry. Tara Murphy put this presentation together. She's one of my cohorts. She's actually up in Michigan, so you can ignore that page. So I will be happy to take any questions you may have.
Yeah, if you have some questions, put them in the chat and we'll
Okay.
get to them. As soon as you see something pop up here. I have a quick question, Perry.
Mhm.
If on business acquisitions, if I have an SBA loan on my existing business, I do want to purchase another one. Is it okay to get another SBA loan, or do I have to consolidate the two?
No, you can get another SBA loan. As far as the 7A is concerned, you can borrow up to $5 million. So you can have as many SBA loans as you like, as long as the aggregate amount does not exceed 5 million. Now, you can also have an additional 5 million in the 504 product, which is designed for real estate only. So theoretically, you could have up to $10 million in SBA loans, several different loans, and that 10 million would include 5 million exclusively on real estate.
Excellent. I do want to comment on the debt consolidation, because that is something we've worked on a lot. And through this pandemic, a lot of folks, have taken advantage of online lenders, especially in the restaurant industry. And some of these terms are onerous. And this SBA loan products and with Perry, I mean, it's been amazing how much the payments, the cash flow changes once you consolidate this debt into something that's more manageable. And what's more importantly, I don't know if anybody's ever tried to call an online lender with a problem. It's almost impossible. And you can always call Perry and he'll answer the phone every time.
Yeah, absolutely. And we're seeing a lot of that because people have had to reach out to resources that they normally wouldn't in order to get the funds that they need to continue to operate. So yeah, if someone has found themselves in that position, then we can certainly take all that debt, combine it, amortize it over 10 years, and hopefully improve your cash flows.
Yeah. A quick example that I worked on, this one restaurant they were paying about $7,000 a month in online loans, and it was through a refinance and SBA, and extending these terms out. They went from that payment to about $1,500 a month. So their cash flow was really improved. So something to look at.
Yep, absolutely.
So Perry, are there specific programs for veterans that the SBA has?
Well, there are specific programs, but most everything that we have, and not we, everyone, as far as the 7A is concerned, anything that the SBA allows, we offer. Sometimes there is a fee waiver, which means the SBA fee, the guarantee amount. Anything that the SBA allows, we offer it. Right now, with the second CARES Act, the SBA has, they've done away with the fees up until September 30th, 2020. If anyone's researching, I'll go ahead and address this. Originally, the SBA was going to make the first 3 months payment for any business transactions that were closed between March 1st and September 30th. However, in the second round of CARES Act funding, they actually capped that at a dollar amount, and all those dollars have been used up. So the 3 payments made by the SBA is no longer applicable, but the fee waiver is. And back to the question about for veterans, with the 7A space, it does not matter if you are minority owned or if you're a veteran. That program is a very broad program, and typically there's not the same benefit as far as the 504. So with the 504 program, there are actually job creation components in order to qualify for that loan. So for every $100,000 that you borrow, there is a job creation component. So under the 504 program, the veteran status and the minority status allows you to do away with that job creation component. But with the 7A space, to be completely candid, that there are some small benefits, but anything that's available, we're certainly going to offer it.
So Perry, what if you are you've been in prison, you're released, you paid your debt, but you do have it on your record, or are you disqualified from getting SBA financing?
No, you're not. We are going to do what's called a LexisNexis search. And that LexisNexis search is going to tell us everything about your life. So if you have criminal activity, no, that does not disqualify you from SBA financing. What we will have you do is fill out a form explaining what the events are surrounding that, get a detailed explanation. And as long as everything is cleared up from that point forward, then we can move forward with it. And I will say that more speeding tickets are issued out of the state of North Carolina than any state in the nation. Everybody's got a speeding ticket, and that's how deep the LexisNexis goes. So if you've got a speeding ticket, it's going to show up. But yeah, that is not a disqualifying event.
That's great. Thank you. Cynthia wants to know, let's see, what if our debt's affecting our credit, but our business is strong as far as debt consolidation for equipment purchases?
I didn't hear the first part of that.
Says, what if our current debt is affecting the credit, but the business itself is strong as far as debt consolidation?
Just to be completely honest with you, it's going to depend upon how bad it's been affected. So if this is something that's occurred over 12 months and we've got slow pay over that 12-month period and your credit score has fallen before 640 or below, to be completely honest about it, our hands are tied. There's simply nothing that we can do. Now, if it's a rather recent event and your credit score is still above 640, then what we can do is get an explanation of that and be able to demonstrate, hey, if we're able to refinance this and amortize out the payments, then we can make a case for it. But everything up to that point would have to be clean, and then we could demonstrate it back to COVID. I mean, to be completely honest with you, this is still kind of some uncharted space as well, because with the PPP funds, I don't know that the full fallout has necessarily occurred as far as COVID is concerned on companies, profit and loss statements and on their credit reports. There was a lot of money that was put out, so people were able to support themselves with that and continue to make their payments. There were a lot of fee waivers, a lot of rent waivers that allow people to get through it as it should have been. But as some of that stuff goes away, if sales are slow to materialize, then, there may be some credit impairment. So, I'll be happy to speak with someone on that on a case-by-case basis and get more detail. But again, to be completely candid, if your credit has fallen to the point that it's below a 640, our hands are going to be tied.
Mm-hmm. Thank you. What about mobile businesses? So Shannon's working on a mobile hair salon or even like a food truck.
Yeah, absolutely. We're able to do those. Now, those smaller deals, typically what I do in those transactions, I try not to dip below $200,000 as my loan amount. But in our branch system, although we don't have any branches in Louisville, the only branches we have that are Huntington branches are in Northern Kentucky. The nearest one we have is Walton. So if you're interested in a smaller loan amount, I can certainly refer you to the branch manager at our Walton branch, and she can process that application for you. But yeah, food trucks, mobile businesses fit very well into that space. The only time a mobile business does not fit well into the SBA is if it's over the road trucking and our trucks are strung out all over the United States. But otherwise, yeah, that's perfectly acceptable.
Cool.
I mean, realistically, any idea that you have, if you can make money for it, unless it is an ineligible business, it will work in SBA. So if you ask me what an ineligible business is, I will give you a very quick example. I'm sure most people have heard of the Curve for Women's franchise, which is a fitness boutique for women only. That is not eligible for SBA financing. And the reason it's not eligible is because they do not allow men to join, so therefore it is considered discriminatory. So as long as your business is SBA eligible and you do not discriminate, then it certainly fits in the SBA space.
Not to get in the weeds too deep, but I do have a good question on business acquisitions. And you mentioned seller's notes earlier, but sometimes also consulting agreements are kind of baked into that too. How do you handle that?
Well, that's where we touched on the PA portion of it. A consulting agreement and an acquisition would not be eligible for SBA financing. So what that means is if you've got an owner that is selling and they want to remain on as a consultant, they're not going to be able to do so. They can only be in the business for 12 months post-acquisition. Additionally, if there are any post-closing adjustments that are built into the purchase, so hypothetically, let's say when you're selling the business, you're going to pay a certain price, but it's contingent upon retention of an existing client. In order for that price to be realized, that's not going to be eligible for SBA financing. So if you've taken somebody on, or you've got carve-outs or anything that is going to adjust the sale post-closing, that would not be SBA eligible. But yeah, if you want to sell your business and remain as a consultant, that will not be eligible. You can stay for 12 months and that's it.
Okay. So if any of you folks out there have any questions, just go ahead and put them in the chat or the Q&A box there. We'd be happy to get to them. Back to acquisitions again. Something that I see a lot, maybe you can kind of touch on this a little bit, is when you're looking at a business, especially if you're going to a broker, they always talk about seller's discretionary earnings. And what do you feel about that?
That's going to get a big chuckle for me, because what seller's discretionary earnings are is a broker taking back all the personal expenses that the seller has attempted to run through his business and add them back to cash flow in order to increase the sales price of the business. So my chuckle to that is seller's discretionary earnings they're not applicable in my world, because typically what we see is cell phone add back, we see health insurance add back, because they say, well, these are the seller's personal expenses. The cell phone expense is personal, the health insurance is personal, therefore we're going to add those back to cash flow. Well, the new owner is still going to have a cell phone, and the new owner is still going to have health insurance. So no, we would not be able to use what the broker calls seller's discretionary income. Now, if they've had some one-time charges, hypothetically, let's say that they had, let's say they got involved in a lawsuit and they had $30,000 in litigation expense, and that's the only year that we saw litigation expense in the profit and loss or the tax returns, that would not necessarily be discretionary, but it would be an add back. But yeah, I mean, pretty much we're going to focus exclusively on net income, interest, depreciation, and amortization. Those are the areas that we're going to focus on. Sometimes we'll see with a lot of businesses that the bottom line, they may not have a lot of net income, but what they do have is a huge owner salary. So what we're able to do, let's say hypothetically, they're showing owner's compensation of $250,000, zero in net profit. Obviously, they've chosen to be taxed at salary and wage as opposed to S Corp income or bottom line income. So in that instance, what we can do, if that salary for that position is normally $100,000, then we can take that 150 and add that back into cash flow, because that would be considered discretionary. Excess officer compensation would be considered discretionary.
Thank you. Ricky wants you to touch again on the what we're talking about, the dollar minimums. You mentioned that you have a $200,000 minimum loan amount. What if he needs less? You think can we go through that again?
Realistically, it depends upon how much less, Ricky. If you want to reach out to me, I'd be happy to have that conversation with you.
Yeah.
If it's a whole lot less, then what I can do is just simply send you to the branch manager up in Walton, and just to, again, pull back the curtain a little bit, the difference between the branch process and my branch process, or I'm sorry, my underwriting process is this. Anytime that I put up a credit through my center, we're going to use what's called judgmental underwriting. That means we're going to sit down, we're going to break down the business, we're going to take a hard look at it, and we're going to analyze the transaction in and of itself. On smaller amounts, what we're going to do, it's going to be a scored system, and basically it's going to be comprised almost entirely of your personal credit score, and then also what the net income of the business is. So the smaller amounts are just designed to push through the system much quicker. One area I would like to touch on real quick, it wasn't a slide, it wasn't in the slides, but coming up with money for a down payment, if you have a large IRA or retirement account available to you, that can be converted to a usable asset for equity into your business. And It's what's called a ROBS transaction. I know just enough to be dangerous. So if you just want to Google ROBS, and what that allows you to do is to take the equity from your retirement account, convert it to a stock, and you can hold that stock in your retirement account. And then that way you do not have to pay the penalties or the taxes as you would on a normal distribution. So you get benefit of the entire amount that you withdraw from that account, as opposed to normally 50% after taxes and penalty. And I was trying to read that question at the bottom, Dave, and I didn't catch it all.
Okay, it says, Andrew says, cash out refi on rental home for down payment help allowed.
As far as that is concerned, wherever you get your equity from is fine. It just could not be through Huntington Bank. So if Huntington Bank were to provide the cash out refi as equity in, then the SBA would deem us as financing 100% of the transaction, because realistically, a cash out transaction is not equity. It's just debt in a different form.
Mm.
That being said, if you have a lot of equity in your primary residence or other property, and you can go to another lending institution and you can take the cash out of that property, then yes, it can be used as equity into our transaction. However, what we're going to want to know is what is the monthly payment on that additional debt, because we're going to look at cash flow from two different perspectives. We're going to look at direct project cash flow, which is the cash flow of the business itself that you all are actually buying. And then we're also going to include what your personal expenses and your personal income is. So obviously that debt payment is going to fall on the personal side, so we'll need to know what that is. But yeah, you can use that.
Thank you. So if you have any questions, we're coming up to the top of the hour. Maybe you can pop them in very quickly. I've put Perry's contact email there in the chat there. It's perry.l.dunn, D-U-N-N, @huntington.com. And I've also put my contact info in there if you'd like to reach out to me if you need some help with your business plan or putting your package together. That's what we do here at the SBDC. Or you can ping us at louisvillesmallbusiness.com. We'd be happy to help you out. We've got a great team here, as Perry said. So let's see. Looks like that's about all the questions we have at the moment. So Perry, I want to thank you for joining us today. It's always a pleasure to see you. And please reach out to Perry. He is the most tenacious banker in Kentucky. And so if you need a tenacious banker, he's the guy to contact with.
In closing real quick, let me just say that yes, the SBDC in Louisville, they're a great group. I love their packages. They make my life a whole lot easier because they know exactly what I'm looking for in a transaction. And it's a lot easier when you get that done on the front end. And then secondarily, I would say, if you have already been to a financial institution and you have been declined for your request, just because another institution declined you doesn't mean that we will. I know that I've had several loan closings where the business that we ultimately were able to get financed, they had been declined as many as 2 and 3 different times by other lending institutions. And then they finally got to us and we were able to get the deal done.
Awesome. So let me just share this here with the folks again. There we go. There you go, Andrew. Oops, that is the wrong email address. So perry.l.dunn, Dunn @Huntington Bank. We'll send you a copy of the recording today. And then we'll also include Perry's contact info in that. But
yeah, I apologize for that. I sent that over and had an appointment and I didn't vet it to the very end. So that's on me. But thank you all. Enjoyed it.
Yeah. So thanks everybody for joining us again for another Toolkit Tuesday, and we'll see you in a couple of weeks. And with that, have a great afternoon. Look forward to seeing you soon. Bye-bye.
All right. Thank you.